This is the third video in our fair value gap series. Today, we're going to learn what a fair value gap is and how to use it to plan trade entries. Before we start today's video, if you'd like to receive offers on courses, exclusive tools and indicators from Rober, as well as market information and signals for gold and Forex, you can join the community via link pinned in video description. And of course, everything is completely free. First, let's understand what a fair value gap actually is. Whenever price leaves a balanced area and moves quickly from one area to another, creating large candles, an imbalance forms. In the example on the left, there are more buyers than sellers. Buyers become willing to buy at higher prices, increasing buying pressure and pushing price sharply higher. Similarly, when there are more sellers than buyers, sellers are willing to sell at lower prices, increasing selling pressure and pushing price sharply lower. Simply put, more buyers create stronger buying pressure and drive price higher, while more sellers create stronger selling pressure and drive price lower. This is how price moves between balance and imbalance, creating different chart patterns. When the market breaks out of an accumulation zone, if buyers dominate, price breaks to the upside. There may already be sellers above with sell orders waiting to be executed. However, when price is trading near its lowest levels and a large number of buyers begin buying, price starts moving higher. But if there are fewer sellers than buyers, sellers who previously placed their sell orders lower will shift those orders higher. As a result, buyers are forced to purchase at higher prices, causing price to move sharply higher. This creates an imbalance, or gap, which we can clearly see between the two candles. Because buyers have purchased above the fair value, or reasonable price, we call this a fair value gap. Now that we understand price imbalance, let's learn how to draw a fair value gap on the chart. During an uptrend, if this candlestick pattern forms, we mark 3 candles from bottom to top. By drawing 2 lines around the closing price of the first candle and the opening price of the third candle, we can clearly see a gap. This is a price imbalance, or bullish fair value gap. Similarly, in a bearish trend, we draw lines between the closing price of the first bearish candle and the opening price of the third candle. The gap between them is a bearish fair value gap. However, in a bullish move, if the first candle's wick extends above its closing price, we draw the line from the upper point of that wick. We then draw another line from the lower wick of the third candle. If a gap exists between these 2 points, we consider it a valid fair value gap. If price creates balance, allowing buyers and sellers to participate equally, and no gap forms between the candles, there is no fair value gap. We call this balanced price action because there's no imbalance in price. Quite often, after a large bearish red candle forms, the next candle may open and close within its range, creating an inside candle. In this situation, we consider the first large red candle as candle number 1 and number the candles accordingly. If we draw 2 lines from the highest point of candle number 1 and the lowest point of candle number 3, the gap between them is the fair value gap. Therefore, whenever an inside candle forms, always use the high and low of the master candle when drawing the fair value gap. Many traders incorrectly use the high and low of the inside candle. The same principle applies in bullish price action. If an inside candle forms within the master candle, draw 2 lines between the lowest point of the large green candle and the highest point of the third candle. This allows you to mark the fair value gap correctly. If several small inside candles form within one large candle, you should still use the highest and lowest points of the large master candle when drawing the fair value gap. Understanding these points and correctly marking the fair value gap will help you achieve better results. Now let's understand which fair value gaps are valid and which are invalid. Part 1. Fair value gap must be unmitigated. Whenever price creates a fair value gap on the chart, the market will usually attempt to move back towards that gap, at least once to fill it. After filling the gap, price may then continue in its previous trend. This means price normally uses this gap only once. Therefore, a fair value gap remains valid as long as it is unmitigated, meaning it has never been used before. However, once price fills a fair value gap, it becomes mitigated, meaning it is no longer useful to us in the future. For this reason, a fair value gap is generally used only once, and once it has been mitigated, we no longer consider it for future trades. Part 2. Candle closing and fair value gap. Quite often in the market, price enters a fair value gap area and, instead of respecting it, continues lower, breaks through the zone, and the candle closes outside the fair value gap. If this type of situation appears on the chart, it is an invalid fair value gap, and we can no longer use it going forward. This is because price has moved below the gap and closed there. Therefore, we can no longer plan a trade entry in the direction of the previous trend from this area. However, if price moves down into the gap area, forms a long lower wick, and the candle closes around the 50% area or above it, we can consider it a valid fair value gap and plan a trade entry in the direction of the trend. This is because price faced resistance whilst trying to move below this area, meaning the zone still has the ability to reverse price. The market has also swept the liquidity below through the lower wick of this candle, which increases the chances of price returning to trade in the direction of the previous trend. Part 3. Use 50% area for bigger candles. Sometimes when price trades within an accumulation zone for a long period of time, the breakout can be very strong. As a result, large candles form on the chart, making the fair value gap area much larger as well. In these situations, you cannot always wait for price to reach the lower part of the zone because price often reverses directly from the starting point of the fair value gap or around the 50% area. Because of this, you may miss the trade entry. Therefore, if a very large candle creates a fair value gap on the chart, you can place your trade entry order around the starting point of the zone or around the 50% area. This can also make your stop loss smaller. If you enter from the starting point of this candle, you may need to place your stop loss further below. This makes the stop loss larger and can negatively affect your risk-to-reward ratio. Because in options trading, you need to aim for at least a 1-to-2 target. Therefore, if you enter the trade from around the 50% area, your stop loss becomes smaller, allowing you to maintain your risk-to-reward ratio. Keep one thing in mind. If a bullish fair value gap forms on the chart, the starting point begins from the upper side of the zone. Therefore, this is where you should start planning your trade entry. And if a bearish fair value gap forms on the chart, the starting point begins from the lower side. Therefore, you can plan your bearish trade entry from there. Part 4. Find valid break of structure. Whenever price creates a valid break of structure on the chart and then comes back down, there is a much higher chance that price will take support from the fair value gap area and move higher again. This is because after the market breaks this swing, the retail traders who entered the market after seeing the breakout have already had their stop losses hit. The market has therefore swept their stop loss liquidity below. Because of this, price can take support from this area and continue in the direction of the previous trend. Therefore, if price comes into a fair value gap area after creating a valid break of structure on the chart, this becomes a high probability trade entry setup. If you enjoyed this video, make sure you like the video and subscribe to the channel. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you.